We're going to have one of the sharpest, best investors in the country. Don Luskin's going to come on. He's going to make the gold case. And he's not alone. He's not alone. And as you know, Wayne, supply-siders tend to be split on the gold issue. Gold went up again today after the Fed action. Gold has been going up in anticipation of the Fed action. I know you've emphasized home price declines as the most important price target right now. What can you say to our friends who are pointing to gold and saying the Fed has made a mistake and inflation is going to rear its ugly head again?
And I always look to it for guidance. But I'm very well aware, as Chairman Bernanke has to be because of his concentration on the history of the 1930s, that gold gave a bad signal to the central bank in the early 1930s. And so sometimes gold doesn't provide the sterling look to the future that we would want.
Let's stop there. Let's get Don in. Don, your response. There's a chart up there, gold and oil have marched together in lockstep. Now, I know you don't agree, but I have posited the theorem. I have posited the theorem that brand new round of Iranian attack jitters, stopping them from exporting oil, possibly bombing them, could have a lot to do with oil, and that's pulling up gold. What's your thought?
Well, just look what happened in market action today. The Fed made its announcement. 15 minutes later, oil breaks to new highs, gold breaks to 27-year highs, the dollar breaks to all-time lows. Iran, I think not. Bernanke, I think so. I think that's where the story is. I don't think this was Bernanke's coming out party. I think this was his caving in party. I think he caved in to market demands. He had no choice but to cut rates. If he didn't, he was afraid there'd be another round of volatility and turbulence. He couldn't have that on his conscience. But I'm telling you, this is it. He's not going to cut rates again because he can see the gold price. He can see the dollar price.
Well, that's an interesting point. And he seemed to hedge himself with that inflation paragraph, which we didn't have back in August 17th.
That was a neutral stance, not a dovish stance.
I actually buy into that.
Your point is very well taken.
It is a neutral stance. He can have a coming out party, which could be a caving in party. Let's pick up that strain. Then I'm going to get everybody else in, Dennis and Michael Metz. Do you believe it's an inflationist thing? And how and what happens now? In other words, everyone's worried about recession. Is the next move, in your view, you know, a quantum increase, a significant increase in inflation's kind of withered down towards 2% again? You expect it to jump up to 3–4% and so?
Oh, it'll take time. We have a whole new wave of inflation impulses that are beginning now with the Fed that's loosening when it doesn't need to. It'll take a while for that to play through. I think the gamble that the Fed's making is that they can take back this rate cut before it gets out of control. You know, we'll see how it turns out. I think that's skating on thin ice. We'll see.
Basically agree with Michael Metz's view, and I want to ask you, are you following up? Is that part of your investment strategy, natural resources, commodities, materials, energy?
You bet. Materials was the best performing S&P sector today. Materials and energy have been the best performing S&P sector since the August 15th bottom. It just doesn't take a genius. Just look at the cards in front of you and read them and play the hand. You got to go with the inflation plays.
One of the interesting things about your scenario in the past year or so is you have been worried about inflation. You don't want the Fed to cut rates. But unlike some other bears, you've said, heck, for now, stay in the market, which proved to be a very good call. Are you going to, heck, stay in the market now?
Yeah, I am. I mean, at least for a while, because what the Fed did, obviously enough, with today's action, is a tremendous accelerant. It's going to be great. There'll be a price to pay. There will be a hangover. We're going to have to do something about this a year from now. But for the time being, you know, you got to go with the language that you hear all day on CNBC. Skyrocket, surge.
You go with the flow.
That's what it was.
You go with the flow.
That's what it was.
Ben's problem, one of his problems is he was appointed by George Bush. Right? So there's Bush bashing, you know, the Dems just go...
Tainted, right?
That's right. Absolutely tainted. They go nuts over this stuff. Second of all, there's a pretty much concerted assault against wealthy, successful people. Raise the top rate. Obama just said we're going to raise the capital gains rate. Obamanomics today. What do you make of this? Could money be an issue? Could the Fed be an issue? I don't believe any of the Dems will reappoint Bernanke.
No. Well, especially now that he's taken this move, which will not just be seen as bailing out rich people, not just seen as bailing out capitalists, but bailing out President Bush. This was the time to have a big rate cut to get the economy into a state where Republicans have a chance in 2008. So you're going to get Barney Frank, who was begging for a rate cut when he didn't think there was going to be one. So when there wasn't one, he could complain that there wasn't. And now that there was, he can complain that there was.
That is a great point.